After shares of Intuit were up 4.3% on the day, those gains are reversing in the after hours as this company just reported their Q1 results after the bell. For a company that once steadily outperformed the S&P 500 year to date, you've seen that underperformance even over the past 1 year, even over the past 3 years. This company is significantly underperforming your benchmark. And so can you get to a point with Intuit once again where you begin to outperform not just other names out there, but in fact just your benchmark? We'll take a look at that in the context of their Q1 earnings, which again came out after the bell. In terms of the stock performance, we'll take a look at the technicals, and this one is coming down to a level where you've probably seen this one only rebound off this point maybe a couple times over the past 2 years. So if you're looking to maybe take a crack at or a swing at shares of Intuit, you probably have some opportunities coming up with this one. Hey guys, hope you're doing well out there. It's been a while since we've covered shares of Intuit Incorporated. And certainly this is a unique company. You have some good and bad that comes with Intuit. First of all, you have a huge, gigantic $182 billion valuation. Keep in mind, as we go through these earnings, that valuation does look monstrous, at least for these current quarters. Keep in mind, Intuit is one of those companies that sort of has their majority of their revenues, profits, earnings come through in their Q3, which is the end of tax season. And so right now in Q1, you won't see those numbers really fit into the context of a $182 billion valuation. The other thing you have with shares of Intuit is you get a small yield of 0.6%. One nice thing is that they continuously increase that. We'll take a look at the dividend. That is one of the stories while you probably continue to buy and hold shares of Intuit. But again, that stock performance is really speaking for itself. This company over the past 3 years basically just flat on a price return perspective. Now, when you factor in those dividends, you're probably up a little bit, but again, still underperforming your benchmark significantly. Now, in terms of the Q1, revenues came in at $3.3 billion. That was good for 10% growth year over year, beating estimates on Wall Street. Now, 10% growth certainly is, I'd say, decent. I think when we take a look at shares of NVIDIA, yesterday, I think people tend to get a bit spoiled when you take a look at 100% year over year revenue growth. I think there's not many companies, certainly Intuit isn't one of them, that is putting up numbers like that. So just 10% growth is nothing, I think, to get overly excited about. Is sort of pretty mediocre growth. Now, in terms of the bottom line earnings, those also coming in ahead of estimates on Wall Street with non-GAAP EPS of $2.50. Now, the first thing I want to point out with the earnings is last year in the same quarter, they posted $2.47 on a non-GAAP diluted basis. This year they came in with $2.50. So you're not really seeing growth on that earnings side. Now, a lot of it comes down to the fact that this company isn't really able to bring in those operating expenses. And so despite raising your revenues 10%, you're not seeing that translate to bottom line earnings growth. And that is red flag number one. This wasn't a great quarter over at Intuit from just an earnings perspective, simply because their expenses aren't able to be held in check. Now, we'll get more into their Q1 numbers, but what I want to pay attention to is the guidance this company provided for the current Q2 we are in. So in terms of revenue guidance, they're expecting 13 to 14% growth with a midpoint of $3.83 billion in terms of the upcoming quarter. The average estimate on Wall Street was closer to $3.88 billion. So coming in right underneath $50 million shy from the average estimate on Wall Street. They were a bit ahead of the low end estimate, but again, when Wall Street is anticipating nearly 14.5% growth, Intuit guiding somewhere around 13.5% growth on their midpoint for the revenue, that is disappointing for a company still, I'd say, pretty decently or fairly valued, close to 35 times a forward earnings multiple. And especially when you're not really able to control your expenses, that revenue growth isn't really translating to bottom line profitability, because again, for the upcoming quarter, this company is guiding for a midpoint in terms of bottom line EPS of right around $2.57. If we take a look at the same quarter last year, it was actually higher at $2.63. So this company is telling you they anticipate those earnings to really be flat to maybe even down on a year over year perspective. And when Wall Street is anticipating nearly 24% earnings growth, and this company tells you, yeah, that earnings really won't be growing at all year over year, again, for a company that's, I'd say, fairly valued around 34 times a forward earnings multiple, that is, with no doubt, absolutely disappointing. And I think that's one of the reasons why you're seeing those shares slide in the after hours. Again, whenever you see revenue growth but not translate into earnings growth, pretty much tells you the picture or the reason to blame for that is expenses being out of control. We'll certainly take a look at that as we dive into the financials. Now, one thing I do want to point out with Intuit is the dividend growth. This company really has been, I think, known as a dividend grower, certainly over the past couple of years. I think it will, moving into the future, really be known as one of those tech companies that consistently grows their dividend very nicely. I think along with Meta, along with Salesforce, you can even throw maybe Microsoft in there. So you have a subsection of these technology software as a service companies that now are sort of throwing you that dividend and consistently growing it. And so Intuit growing that dividend year over year, pretty much in the mid-teens for the past, call it, decade. And so that's one thing you like to see. You can continue to hold this company simply because of that growing dividend. And while it's not a huge dividend at the current time, that I think as you continue to hold it, your cost basis on those dividends will certainly look to be pretty nice. One thing I also do want to point out is anytime you get this company closer to, I'd say, a 1% yield, that's probably a signal where you're probably getting a better deal on shares of Intuit. I've seen this one trade around 1%, come down as low as maybe 0.4% on yield when the stock really races up. And so in my opinion, one of the easiest signals to know whether you're getting a decent deal on Intuit shares or not is you take a look at this yield. If you get it close to a 1%, maybe 0.8% yield, that's probably when you're looking at a pretty good deal at shares of Intuit. Now, this news story coming out a couple of days ago, the Department of Government Efficiency, that new sort of government agency that's being banded together by the incoming Trump administration, led by, of course, none other than Elon Musk, is looking into a free mobile tax filing app. So this report, again, coming out of the Washington Post a few days ago. Now, of course, Intuit's biggest revenue stream is TurboTax. They also have other revenue streams like Credit Karma and MailChimp. But again, TurboTax is the bread and butter over at Intuit. And of course, that is a app, or that is a software that many people pay for to have their taxes filed. Now, if the Department of Government Efficiency puts together this sort of free mobile app for users to file taxes, that can absolutely take away some of Intuit's TurboTax revenue, which again is their largest revenue stream. Now, one thing I do want to point out is this report did mention that these discussions are highly preliminary. That is according to the sources. You also had the Trump administration still yet to come into the White House. You're still a couple months away from that new regime really coming into the White House. You also have some transition of powers that will still need to take place. You're still probably looking at maybe a year away, in my opinion, from this really being anything meaningful. On top of that, you had the Biden administration, the outgoing current presidency, also try this sort of idea of a free website in order for residents to file taxes. That idea back then was met with resistance from Republicans. We'll see maybe if those Republicans now coming around to that idea. But again, that portal that was sort of that free website in order to file taxes was still, I'd say, used by 100,000 taxpayers, but I'd say mainly not adopted to the extent that I think the Biden administration really would have liked to see. That was part of his Inflation Reduction Act. I think the main reason that the adoption wasn't really there is because it's very difficult to emulate and duplicate what TurboTax does for residents and consumers really filing taxes. Also, you have small businesses filing taxes through things like TurboTax, and that is a pretty complicated software, a pretty complicated app. And so to replicate that, first of all, the government will have to hire a ton of engineers in order to just do that. And so I'm not really sure how that is a more efficient way to manage federal funds. But okay, even if they're able to do that, I think it's very difficult to replicate what TurboTax does and how easy really it makes it for consumers to file taxes. So I think for TurboTax and for really shares of Intuit, over the next 1 year, maybe even over the next 2 years, certainly I don't think this would have a meaningful impact. Maybe over the long term, you could have some overhang on shares of Intuit, simply because if the government of efficiency really goes ahead with this, and if they're able to be successful with this, then yeah, absolutely, shares of Intuit will take a beating, because again, TurboTax is their bread and butter, at least at the current time. But I think in the near term, really over the 1 to 2 year period, probably have nothing to worry about as it relates to that. Now, in terms of the financials, despite growing your revenues 10%, it wasn't a great quarter over at Intuit. It's like we said before, so you grew your revenues up to 3.3 billion. Last year, you were just a shade underneath 3 billion. But what I want to mention is the cost of revenues coming up in line with that, up nearly 10%. And then what's more worrisome is your selling and marketing growing faster, up to nearly 960 million. Last year, you were at 780. You're also seeing growth on your R&D, although relatively under control, up from 680 to just a shade over 700 million. But again, your G&A also coming up from 340 up to nearly 400 million in the most recent quarter. And so what that leads to is your cost and expenses actually growing faster than your revenues? And that leads your operating incomes to decline. That's right, decline year over year from 307 down to 271. So despite raising your revenues 10%, you actually saw your operating income slide by right around 1%. And so just right there, that's not a great sign. Anytime a company is able to grow revenues but unable to translate that to operating income, let alone have operating incomes actually decline, again, that's not a great sign. And especially as this company is guiding for another quarter of flat earnings year over year, again, you're not seeing that operating efficiencies or that leverage really shine through over at Intuit. And so what that leads to is your net income, again, being down year over year. You are holding your shares outstanding relatively flat because you do have a little bit of a buyback over at Intuit. But really, if there's one thing I would want you to pay attention to for this quarter is the fact that operating income year over year did slide despite, again, growing your revenues nearly 10%. Now, from a balance sheet perspective, it's also not all too rosy over at Intuit because quarter over quarter, you had cash leave this building as you went from 3.7 down to, call it, 2.9 billion on your cash side. You still have a fair amount of total current assets, nearly 10.7 billion, but that is very nicely offset by, call it, about $500 million in short-term debt, and then you still have nearly $5.6 billion in long-term debt. So I think from a balance sheet perspective, Intuit also has some work to do because you have less cash than you have long-term debt on the balance sheet. You have nearly twice as much long-term debt, in fact, than you do cash. So this company still needing to, I'd say, sort of work on that balance sheet, bolster on a bit more cash, in my opinion. Now, that is tough to do when you're printing just $200 million of quarterly net income. And even after adjusting for stock-based comp, you come up to just $400 million in operating cash flows. Again, that's for a full quarter for a company worth $182 billion. Now, keep in mind, like we said at the top, a lot of that cash flows gets generated at the end of their Q3, which is the end of tax season. So a bit skewed in that sense, but still call it $400 million in operating cash flows doesn't give this company a whole lot of room to sort of work around with that cash. So they did a little bit of CapEx. One thing I do want to point out, that CapEx year over year is down. That's also something they are guiding for, that CapEx to go from 260 down to 250 last year. And now this year, expecting full year CapEx of right around $175 million. So they are looking to rein in costs on that perspective, but you're still not seeing that cost come down on the operating expenses side. And so majority of their cash goes toward the purchase of common stock, nearly $550 million in the most recent quarter. They also, again, give you that dividend that consistently grows year over year. The buyback really just offsets dilution, so you're not seeing those shares tick down in any meaningful way. You're also not seeing those tick up in any substantial way either. So all in all, this quarter wasn't really all too great over at Intuit. You did see that revenue grow nearly 10%, but none of it really translated to bottom line profitability. Certainly none of it translating to operating cash flows, free cash flows growing. This company sort of just floating and treading water in this quarter as they had that buyback and that dividend. But again, you didn't really see your balance sheet improve all too much. You also didn't see year over year growth on your bottom line profitability. And again, that's one of the reasons why you're seeing shares slide over 5%, nearly 5% in the after hours. Now, over the past, call it 1 to 2 years, in fact, you've seen this one basically in a very predictable channel of higher highs and higher lows. Anytime it comes up close to this red line, it's probably your signal to maybe peel off a portion of your position. You don't need to certainly peel off your whole position. And then anytime you come down to this dark green line, that's probably a signal to maybe step in and buy. And so if you are looking to swing this one, you probably have some level of support here at the $640 range. Now, keep in mind, you could certainly break through that and come back down here and maybe retest a bit of support at the $600 level. Certainly, I wouldn't put that out of the question because you are seeing shares slide, again, 5% in the after hours. If that weakness sort of continues in the market, you could see shares of Intuit slide pretty meaningfully. Now, if you get that rebound, I think anytime you come up close to this light green line, right around $700, that's probably where you can look to maybe take some profits, lock in some gains, and at least ease off on the buying altogether. Certainly for me, I would actually wait for a deeper pullback in shares of Intuit down as much as even in the 550s. That's a point where I think shares of Intuit would become far more attractive. One, I think from a valuation perspective, you would have some safety baked in because it wouldn't be all fully valued, nearly 33 times a forward earnings multiple. The other thing is you do have some long-term risks due to the government maybe stepping in and trying to play their hand at developing a free tax filing app. I think that is a more so a long-term risk rather than a near-term one. But again, even in the near term, don't have a great set of financials. This company did maintain their full year guidance, but the fact that your earnings really aren't growing year over year despite growing your revenues is telling me this company has an expenses problem, and the management certainly can do a better job controlling the selling and marketing, also G&A costs increasing year over year. And so from a technical perspective, you could make the case to maybe step in, pick up a fractional share, maybe 1 or 2 shares, and look for a rebound up close to $700. Certainly, it's not something I would want to gamble on. If you do, I would set a pretty tight stop loss down here at the $620 range, because if you break that, yeah, you're probably coming down to the 600s. Again, for a long-term buy and hold perspective, I think somewhere in the mid 500s would be a far more attractive risk reward position. That was my take on shares of Intuit. Not a great quarter despite seeing that 10% revenue growth. You do have still some things to like, especially the growing yield. But until this company finds a way to keep those expenses in check and finds a way to meaningfully increase the bottom line profitability and cash flows over at this company, I think you will see some sort of a lid on the stock, and I wouldn't expect it to have meaningful outperformance, especially when compared to the other names you can buy in the software as a service field, especially names like Salesforce, also names like maybe Adobe, and of course, you always have Microsoft. That was my take on shares of Intuit. Let me know your thoughts on this one in the comment section below. Thanks so much for listening. Subscribe if you haven't already. We're so close to 2,000 subscribers. As always, thanks so much for listening, and I'll catch you guys in the next video.